let's dive deeper into the world of interest rates, inflation, and central banks. Now that we've covered the basics, it's time to explore this complex topic further, and I'll share some additional insights and examples to help solidify your understanding. As we discussed earlier, interest rates are the cost of borrowing money. Now, let's imagine that we're not just looking at lemonade stands or personal loans, but also at the broader economy. When central banks raise interest rates, it becomes more expensive for people and businesses to borrow money. This can lead to a decrease in spending and, subsequently, lower demand for products and services. On the other hand, when central banks lower interest rates, it becomes cheaper for people and businesses to borrow money, which can lead to increased spending and higher demand. However, this can also lead to higher inflation, as there's more money circulating in the economy and people are willing to pay higher prices for goods and services. One common mistake that beginners make is to focus solely on the short-term effects of interest rates on the economy. They might think that a lower interest rate is always good, but this isn't the case. For example, if the interest rate is already very low, lowering it further might not have a significant impact on the economy. Another mistake is to think that interest rates only affect the economy in a specific way, without considering the broader implications. For instance, a lower interest rate might make it cheaper for people to buy houses, but it might also lead to a decrease in savings rates, as people are encouraged to spend rather than save. To illustrate this, let's consider an example where the interest rate is 5, and the inflation rate is 2. If the central bank lowers the interest rate to 4.5, it becomes cheaper to borrow money, and people might be more likely to take out loans to buy houses or cars. However, if inflation rises to 3, the central bank might raise the interest rate to 4.75 to cool down the economy and keep prices under control. In addition to understanding the impact of interest rates on the economy, it's essential to keep an eye on inflation, which affects the purchasing power of consumers and investors. When inflation is high, the value of money decreases, making it harder for people to afford the goods and services they need. To practice what you've learned, let's consider a real-life scenario. Imagine that you're a trader who's monitoring the interest rate and inflation developments in the economy. You're considering making a decision about whether to buy or sell stocks in the tech sector. However, you're not sure which way the economy is headed and how interest rates and inflation will affect the stock market. Using your knowledge of interest rates, inflation, and central banks, write down a series of questions to guide your analysis. If the central bank decides to raise interest rates, how will this affect the tech sector, and what might be the implications for my trading strategy? Remember, the goal of this exercise is not to come up with specific answers, but to think critically about how interest rates, inflation, and central banks interact with the economy and the stock market. By doing so, you'll be better equipped to make informed trading decisions and navigate the complex world of finance. That's it for today's lesson. Recap: interest rates are the cost of borrowing money. Inflation is the rate at which prices rise, and central banks manage interest rates to control inflation. To avoid common mistakes, keep in mind that interest rates are a tool, and central banks use them to achieve specific goals. If you're new to trading, I encourage you to keep learning and practicing. Don't risk capital without a solid understanding of fundamental and macro context. The road to being a successful trader takes time, and I'm here to guide you. If you're ready to take the next step, I suggest you check out our module on economic indicators, coming up next at lesson 50. In the meantime, I leave you with a question: what does the recent change in interest rates mean for the stock market, and how might it affect your trading strategy?